So welcome to the 2017 BVCA Summit. It probably has not escaped your notice that the theme is Revolutionaries, a changing industry and a changing world. And my 15 minutes, rather appropriately, are going to focus on revolution, both in the sense of disruption, but also actually in the sense of moving forwards, or perhaps better categorized as evolution. So we are meeting almost exactly 100 years since the Russian Revolution. It's actually a pair of revolutions, both the February and the October revolutions. And this, I think, is an appropriately reflective theme for our industry. It survived and flourished in no small part because of our revolutionary spirit and because of our activist drive to innovate, to adapt, and to disrupt. So I thought it might be fun just to look back at the last 100 years, but in private equity terms rather than in Russian terms. So early in the 20th century, sorry, that should say 1917 to 2017, but the 7 seems to have dropped off, a la Theresa May, apologies for that. So in the early part of the 20th century, private equity was really the domain of family offices, wealthy families such as the Vanderbilts, the Rockefellers, the Warburgs, the Wallenbergs here in Europe. It was really just sort of after First World War that the venture capital industry got founded and some of the leading firms really got going. Then in the late 1950s, our industry actually got a leg up from government policy, would you believe, and legal creativity. In the US, the Small Business Investment Act of 1958 provided venture capital firms with access to federal funds that could be leveraged 4-to-1 with privately raised funds. So this really gave venture capital a shot in the arm. And then 2 years after the SBA, there was the creation of the new form of private equity fund. It was a limited partnership. Now, this had been around for probably about 100 years before, but it was then retooled for private equity purposes. Then in the late 1970s and the 80s, some pioneering institutional investors got going, started investing in private equity, and we navigated ERISA, and we're still navigating all sorts of complex legal and regulatory hurdles. Sarbanes-Oxley, Volcker, ERISA again, AIFMD, Solvency II, and soon, I hope, MiFID. And along the way, very importantly, we've been helped by our industry associations, and foremost amongst them, obviously today, is the BVCA. We've also had the creation of some modern structures, such as the new Limited Partnership Act and VCTs. But of course, we should really look at some of the iconic deals to get an idea of what's happened over the last 100 years. Some of these are familiar names, but we have to go all the way back to 1946 to the Florida Fruit Corporation, better known as Minute Maid, financed by G.H. Whitney, which was actually the first growth capital deal ever. It was sold to Coca-Cola, and the rest is history. The first real venture capital deal of the modern era was Fairchild Semiconductor. That was in 1957, and it was backed by the legendary VC Arthur Rock. This was really the first deal in what was to become Silicon Valley, and it spawned all sorts of other activities. It spawned venture capital firms such as Kleiner Perkins, and it gave birth to about 2,000 Fairchildren, including Intel and Apple. I don't know how many people here remember Gibson greeting cards or have heard of Gibson greeting cards. That was a deal in 1981, and it actually preceded RGR Nabisco by about 7 years. It was leveraged at a mouth-watering ratio of 8-to-1, and it generated a 200 times return when it IPO'd. I wish I'd been in that deal. However, as an industry, we have to go back even further, and I'm going to cheat a little bit here. It's before 1917. 1901 was actually the first real leverage buyout. And it was when Andrew Carnegie sold his steel company to JP Morgan for $480 million. That was a lot of dosh in those days. That's $12.8 billion in today's money. So the last 100 years have really heralded a financial revolution that's navigated 2 world wars, several economic and market collapses, and the redrawing of political maps. There's been the birth and death of myriad industrial processes and tech innovations. We've also seen the success, failure, and merging of countless venerable corporate and banking brands, and the rapid growth and metamorphosis of what is generally known as private capital. And some GPs here present in the room have had a ringside seat throughout much of this development. 3i in 1945, and actually before that, the origins of Warburg Pincus in 1938 with Warburg. And then in the 1960s, CVC, Apax, 1970s, ECI, Cinven, KKR. In the 1980s, my own firm, Pantheon, plus Advent. And then more recent firms, spin-outs, new brands, rebrands. So I apologize, I can't give everybody a shout-out today, but I think you get the point, that all these firms have been witnesses to evolution in our industry over the past few decades. Now, private capital constantly reinvents and reinterprets itself. This is what I really mean by revolution and evolution. From the origins of private, really meaning family finance, all the way through to venture, to project finance, to LBOs, then to what we now call private equity, splintering into all sorts of subcategories, the advent of private infrastructure, private real assets, private credit, we've seen a huge development of the industry. The collaboration of GPs with government, with quasi-government LPs, the proliferation of all sorts of innovative vehicles that will now allow us to customize and give greater liquidity to private finance. And of course, there's been new domiciles, new regulation, new structures, new markets. And the net result of this is we've grown as an asset class. So today, we're about $2.5 trillion in assets under management, and if you add in real assets, infrastructure, and credit, we're closer to $4 trillion. Now, this continuous evolution has made what was relatively simple previously, a GP, financed by LPs, committing to companies, much more blurred. Especially now that more and more LPs are investing directly or through co-investment, and with the evolving secondary market. Things aren't as simple as they were. GPs, used to be monoline, and now they are plural, multi-strategy. And it's not just the GPs, the LPs have also evolved. There's a broad range now of LP categories, again, some of them blurred. They've all got different requirements, different objectives, and this all adds to the complexity of the ecosystem. And I haven't even added in here the consultants, the intermediaries, the advisors. So revolution and evolution have really created a lot of complexity in our maturing market and increased the issues that we as an industry have to deal with. Now, many of these topics were discussed yesterday at the LP seminar, and I know they're going to be discussed today during the conference, so I'd encourage you all to get very involved in these debates. As GPs and LPs, we need to bear all of these issues in mind. I'm now going to change tack somewhat. I'm going to turn from the evolutionary nature of our industry to a revolution that's been going on right before our very eyes. While we've been laser focused on our own small part of the financial industry, our own little universe, there's been a parallel and seismic revolution that's been going on in public markets. And this revolution actually provides us with an extraordinary opportunity as our own private market universe expands. I'm talking about the disappearing act of the public markets. So here are some startling facts, along with the Cheshire Cat, to shake you to life on this autumnal morning. We have seen a collapse in the number of publicly quoted companies over the last 20 years. In the US, the number of public companies has all but halved despite the fact that capital inflows into the industry, particularly into the US mutual and index fund industry, have exploded over that period of time. This data and the following slides are taken from a study that Pantheon did earlier in the year on the shrinking public market. It's not just in the US and in the other countries mentioned here. In the UK, the number of listings has dropped by 26% since 1996. Now that sounds impressive, but if you delve even deeper and exclude AIM, which really expanded significantly in the early 2000s, you'll see that the main market has seen a 57% drop in public companies. In the US, in the US, new listings have collapsed by 89% since 1996, and delistings have accelerated markedly. In fact, annual delistings have outpaced new listings by 84% since 1996. A similar story exists in the UK, but it's in the year 2000, if you focus on just the main market, and 2007, if you also include AIM. And both have seen a similar drop to the US. Now, the common factor in all of this is actually the expansion of private capital, as entrepreneurs and businesses shy away from the emphasis, the short-term emphasis, on quarterly earnings, activism, regulatory and admin costs, and public scrutiny, preferring instead to tap into the proliferation of new funding sources. Another statistic for you. Private companies in 2016 raised a median of $98 million before IPOing, and that compares to $12 million in 1996. Mutual funds, sovereign wealth funds, corporate venture capital, alongside more traditional private structures, have sunk billions into private companies as they look to private markets rather than public markets to fund the early growth. Now, the consequences for public and private markets, private and public market investors are profound. Not only do public markets no longer offer the breadth and the number of opportunities that they used to, but more than ever, the growth in companies and the value created by early growth is occurring before companies IPO. This is starkly shown by the IPO investor returns on this page of 3 household names, all in the US. So Amazon, when it IPO'd just 3 years after being founded, created 565 times the money for IPO investors. Google, in 2004, created 20 times for IPO investors. But Facebook, when it IPO'd in 2012, only created 4 times the money for investors. We're seeing a similar situation in Europe, with companies staying private for longer. Examples include the food delivery service Just Eat, which listed 13 years after it was founded. King took 11 years to go public, and Skyscanner was founded 14 years before it was sold. And Europe continues to see further unicorns, with more private funding in companies such as Spotify, Funding Circle, Deliveroo. Now, the final piece of the puzzle on why listings have fallen is due to many of you in the room. Take privates executed by private equity firms have increased significantly in both the US and also in the UK. So to summarize, the public universe has been shrinking. Public companies are now concentrated more in certain sectors, and they tend to be lower growth sectors, while companies are growing much more before IPO or before exit. So this limits the growth potential when they do actually IPO. And this means that for most institutional investors, they need exposure to both public and private markets. Now, private equity firms usually invest in smaller businesses, and this contrasts as well with public markets, and those small businesses tend to grow faster. Here are some stats from Pantheon's own portfolio. 87% of the LSE's value is concentrated in companies with a market cap of 2 billion euros or more, while in Pantheon's UK headquartered portfolio, which is on the left-hand side, 89% by cost of equity commitments by the GP are below 1 billion, and 67% are actually below 250 million. Also, private equity has been skewed towards a high number of investments in consumer discretionary, industrials, and technology, all faster-growing sectors compared with the public markets. Even healthcare, which seems to have the same sort of allocation to both public and private, is a different sort of healthcare. Finally, adding to the attractions of the industry, new investors continue to be enticed by the strong relative returns of private equity versus other asset classes. This slide shows data from the 2015 BVCA Performance Measurement Survey. I should point out that the 2016 survey came out on Friday, but it was too late for my slides, and even as the chair of the BVCA, you can't pull strings. So, performance, diversification, fundraising, all continue to work in our favor. However, deal flow has remained relatively stable. Could we be doing more as an industry? Or should we be pleased that we maintain this level despite the great financial crisis, despite the problems and challenges of Brexit? 2017 looks like another strong year in terms of both fundraising and deal activity, but can we keep up the momentum? Here is a final set of stats for you, and I promise you they're the last. So based on the Office of National Statistics, in their data set, there are 2.5 million companies in the UK. About 35,000 of them have more than 50 employees, and 7,500 have a turnover of more than £50 million. The BVCA has estimated there is a pool of about 3,000 private equity-ready companies, but as of 2016, there were 728 private equity-backed companies in the UK. And you can extrapolate this to Europe as well. So there is a pool of interesting companies there ready for us to back. Could we do more to take advantage of our position as private market investors and all our advantages over public markets? In conclusion, private equity has seen its own set of revolutionary events over the last 100 years or so, and it continues to adapt, to reinvent, and rise to the various challenges and the opportunities in our increasingly complex and interconnected world. I think we're all revolutionaries, actually. But is it revolution or is it evolution? It's up to you to decide. Please enjoy the conference, and I look forward to meeting many of you later. Thanks very much.